What if I told you that a $100 investment in the S&P 500 in 1974 could grow to over $22,000 by 2024? Sounds like a dream, right? But here's the twist. While that 22,000% return sounds huge, the real return after adjusting for inflation is just 3,400%. And it's not just rising prices eating away at your gains. It's the massive explosion of the money supply. Over the past few decades, trillions in new money has flooded the economy, making those big gains feel smaller and smaller. In this video, we're going to reveal exactly how inflation and the sheer scale of recent money printing has been quietly destroying your returns. Understanding this will completely reshape the way you approach long-term investing. Stick with us, because the real story behind how money printing impacts your portfolio is more crucial than you might think. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. A $100 investment in the S&P 500 in 1974, assuming all dividends were reinvested, would grow to about $22,626 by 2024. That's a massive return of over 22,000%. Now this is where things get tricky. While that might seem like a huge win on paper, the real return you've experienced when adjusted for inflation isn't even close. After factoring in inflation, that same $100 investment actually only grows to about $3,400 in real terms. This means that while your investment is growing in nominal value, inflation is quietly eating away at its purchasing power. But here's the critical part most people miss. This isn't just the typical cost of living price increases you hear about on the news. What's really driving this erosion is the explosion of the money supply over the past few decades. Now, let's go a step further. The real story behind these numbers isn't just inflation, it's the explosion of the money supply. Over the past few decades, central banks have pumped trillions of dollars into the global economy. In the US, the M2 money supply has skyrocketed since the 2008 financial crisis, rising by over $12 trillion from around $8.5 trillion in 2008 to over $21 trillion in 2024. This surge in money supply has inflated asset prices across the board, stocks, real estate, you name it. But it's also distorted the true value of returns. While nominal prices have risen, the actual value of those returns has been reduced because of the increased amount of money chasing the same amount of goods and services. In short, you're getting more dollars back, but each dollar is worth less. When you look at the U.S. stock market's total market capitalization relative to the M2 money supply, the picture becomes clear. In real terms, the stock market has shown very little growth over the past 50 years. While the nominal value of the market has skyrocketed, much of this growth has been driven by the expansion of the money supply, rather than by real economic value creation. If you adjust for M2, the chart reveals a relatively flat trend, indicating that after accounting for inflation and the increase in money supply, the stock market's real growth has been minimal. This highlights a critical issue with the way markets are evaluated. While nominal prices have risen, the underlying purchasing power of those investments hasn't seen the same increase. It's a stark reminder of how inflation, and especially the massive growth of the money supply, can distort perceived returns in financial markets. So, what does this all mean for your portfolio? The key takeaway here is that in a world of growing money supply and inflation, you need to invest in assets that have the potential to outpace these forces. If your investments are merely keeping up with inflation or the expansion of the money supply, you're not truly increasing your wealth. Since 2020, the Nasdaq has increased by 90% when adjusted for the massive money supply growth. This solid return shows that, despite rising prices, tech-focused indices like the Nasdaq still manage to deliver positive growth. Bitcoin, on the other hand, has proven to be a powerhouse in this environment. Since 2020, it has surged 900% when adjusted for the money supply, far outpacing traditional assets. This dramatic performance underscores Bitcoin's potential as a hedge against the unchecked money printing that has been driving inflation. As an asset class, Bitcoin is a pure play on monetary debasement, as its supply is finite, which makes it an ideal candidate for preserving value in an inflationary world. Gold, historically a reliable store of value, has also performed admirably in this context. Since 2020, gold has increased by 48% after adjusting for money supply growth. While not as explosive as Bitcoin, gold has shown steady resilience, maintaining its status as a safe haven asset. This makes it a great choice for those seeking stability alongside growth in an inflationary environment. So, what does this mean for long-term investing? Simply put, you need to focus on assets that can outpace the money supply, whether it's high-growth opportunities like Bitcoin, solid performers like the Nasdaq, or stable stores of value like gold. Traditional investments, while still valuable, often can't keep up with the exponential rise in the money supply. By incorporating these types of assets into your portfolio, you're positioning yourself to preserve and potentially grow your wealth, no matter what the future holds.